So thank you all for your time today. We're going to keep our examples fairly simple, and I'm going to ask you to save questions until we've finished running through things. A lot's been written about the change in the inclusion rate, especially as regards the realization of gains in investment portfolios, sale of assets such as a cottage, and so on. But what I want to do today is I want to focus more on situations where clients are facing a decision, regardless of the change in the inclusion rate, uh, helping those clients understand the implications of making a decision either, pre-June 25th or post-June 24th. And I believe that the assets that are most relevant in this conversation are actually SARs, stock appreciation rights, RSUs, restricted stock units, and stock options. These are benefits, if you will, that clients have and may be in a position where they need to take action on them in the fairly near future. So, what's the long-term impact? So I'm going to bring up a few examples that I've created, and I'm going to start with a stock appreciation right pre-June 25th. One of the things I'll just make note of is it took us 3 weeks to get this release out, and that may seem like a very long time, but I want you to remember that our database is an annual database. We're doing, very long-term projections. And in the case of an asset, let's say selling a house in the middle of the year, what we're actually doing is we're still using the annual expense, but we're applying a little bit of math depending on the month that a house is going to be sold in order to calculate the property taxes or operating expenses for the year. But in this case, this pre-June 25th and post-June 24th new set of rules we're living under, we actually had to rework the entire database just to be able to accommodate that split in the time frame, if you will, with the new inclusion rate. So just to go through this, I've created a stock appreciation right, and I just want you to notice that it's on 100,000 shares. Exercise cost $10 a share. Price on the exercise date is $15. So just to remind you, the way a stock appreciation right works is that any gain on it is actually treated as a taxable capital gain. It's not included in income. So obviously we have a $500,000 gain here, total gain, and therefore the taxable gain under the current rules is of course 50%. So we can go in and look at the tax return and we can see it's 250,482. There's a little bit of a tag in there just because of the months of the year. So 50% inclusion rate. If we switch over though to our post-June 24th scenario, again, all we're going to do is just change the exercise date, and you can see I've made it July 1. And now when we go to net cash and have a look at the tax impact, we can see that the taxable gain is now 292, up from the 250,000. And I also want you to notice that the total taxes here are 193,000, whereas if we exercised before June 24th, the total taxes were only 148,000. So that's a difference of about $43,000 in taxes. And I think it's important not just to look at the current immediate impact, what's the included capital gain, what's the tax this year, but also to be able to do a comparison where we can look at the long-term impact between the two exercise dates. So actually, let me do this on the left and do the post-June on the right. And we can see if we run our mouse, and I always use, by the way, in doing comparisons, I always look at the life expectancy year minus 1 year. And the reason is in the final year of the plan, you can see I'm on the total tab, we have a state noise. So that's things like capital gains taxes on cottages and, all those other things that happen on the terminal return. So if we look at the impact, what we see is total income assets, 2,255,000, and in the post-June, 2,181,000. So, a reasonable difference. And I think we need to look at that to help clients really understand the long-term impact of, waiting and exercising. One of the other things that I think is really relevant is having a look at clients who are considering converting a principal residence to or selling a principal residence and then converting a secondary residence to a principal residence. So I'm thinking in terms of people who are retired or very close to retirement, the idea being that they may want to consider selling their home. So you can see I've modeled the sale of 6 Iowa Street, and then converting that cottage that they have into their principal residence, maybe using some of the takeout from the sale of the house, let's say, to buy a condo in the city, that kind of idea. So you can see that the conversion date I've put in for the cottage. And I just want to remind you that if we go to net cash flow, what we'll see is the value of the sale of the house. But if we go to cash uses, we don't see any capital gains tax. And that, just to remind you, is because when you do a conversion, the capital gains on the cottage is calculated from its ACB to the value of the property at the time of conversion, but taxes are not owing until that property is either sold or transferred by way of will. And of course, when we're talking about the Bill Sue example, what happens is that gain doesn't apply until Sue's life expectancy, because of course, the cottage, which I have in Bill's name, rolls over through the will tax-free to her. So it's not until her death that we see the capital gain. And I set this up intentionally so that it's on Bill's tab, just so that we could have a look at the terminal tax return where all the capital gain is in one person's name. So you can see that the cottage has an ACB of 250,000, current value $1.2 million. So we've got a taxable gain at the time of conversion right now of $1 million. So now when we go to net cash and we scroll down and we have a look at Sue's tax return, then we can see that we've got a $500,000 gain, capital gain, half the value, because we're converting pre-June 25th. And again, that little bit of extra gain is because of the appreciation rate on the cottage over the next little bit. It's at a 6% per annum rate. So let's just switch to our conversion post June 24th. And then again, if we go to Sue and we have a look at the long-term implications, the capital gain, we can see that it's now 638,000 up from the 250,000. So I wanted to cover these things again because I think these are the decisions that people are facing. I have a stock appreciation right. Should I hang on to it, not hang on to it? Or I'm thinking of at some point doing the cottage conversion. So I thought we should cover that. I think that's one of those things that might be in people's minds. There's been a great deal that's being written about the whole approach with portfolios So I thought I'd run through this. And the reason is, if you're asked this, should I realize the capital gains on my portfolio or not? You have to keep in mind that when we deal with assets like a cottage or like a stock appreciation right, we do have embedded in those a purchase date and a sale date. We don't have embedded in each mutual fund that's bought or each ETF that's bought, the date it was bought and the date it's being sold. So there's the need, and we certainly didn't want to try and accommodate that in the database just over the next couple of months. But there's quite a simple workaround. And so I think this is very important that we have a look at it. So I'm going to the solution that I call capital gains accrued. And I just want to remind you that when you look at tax, other, and accrued, you'll see a lot of entries in here. And these are for things that people have done in the current year up to this point in time. So as an example, someone might have made a large charitable donation earlier this year. We don't want to enter it in the tree view as a charitable donation. That would imply it's yet to be made and therefore would affect cash flow, our uses of funds. But we want to account for that charitable donation for tax purposes. So things that are accrued are things that have happened earlier in the year so that we can properly account for current year taxes. So in this case, rather than having or entering a portfolio that is currently worth $1 million with a $500,000 ACB, what I've done instead as a workaround is I've just gone in and said, up until June, we're going to realize a capital gain of $500,000. And because that's being realized, then what it means is that the ACB of the portfolio is going to be reset to its current value. So we're accounting for that $500,000 realization of the gain. And I also want you to notice that I've applied a 0% return on the portfolio for the balance of the year. So what we're essentially saying is any embedded gain, we've realized it. We're not going to be realizing any more gains in the last 6 months of the year. Or if there are any, they're not going to be substantial. So we've accounted for the gains in the portfolio to this point through accrued. We're saying no more gains for the balance of the year, and then keeping in mind that we can change portfolio returns over time. Then we're going to go in and apply a return, and I've just used a 5% capital gain rate on a go-forward basis. And I've also assumed that we've got just a 20% turnover rate. So it's not that we're going to be realizing, gains every year, all gains every year. So if we have a look then at taxes, what we see, of course, is that the capital gains tax on the portfolio is $250,000, half that 500,000. But then going forward in subsequent years, the capital gain is just $5,000. So it's the portfolio of $1 million times 5% return, $50,000 a year times the 20% realization rate is just $10,000 a year, and that's under the 250. So our inclusion rate is only half of that, $5,000. And again, I think that this is a case where we need to help clients understand, yes, in the future, you may pay a higher capital gain, but what's also going to be true is that you're not prepaying that capital gain, between now and June. And we can see as a result that we've got a real difference in the value of the portfolio. So those are the main things that I wanted to cover. There are a couple of other little thoughts that I have for you, and that's that if you've got somebody, for example, who's thinking in terms of taking a rental property that they have, selling their principal residence, moving to the cottage as their new principal residence, and converting their rental property to a secondary residence, let's say in the city. I just want you to recall that on the conversion of a rental property to a residence, if CCA has been taken in the past, then there's a full realization, a recapture of the CCA and a capital gain. So in this case, I've got a rental property that's fairly expensive. It's worth a few $1,000,000. And the consequence of all of that is that there's converting the rental property to a secondary residence, there's actually a substantial gain that would be incurred. It's only avoided if somebody has in the past not taken CCA. And if they've not taken CCA, then there's only a capital gain. And just like the conversion of the cottage, that capital gain isn't realized until either the property is sold or transferred to a non-spouse or non-CLP beneficiary through the will. So those are the basics, things that I wanted to cover today. And again, what I would invite you to do is just unmute yourself and throw things open to any questions.
Yeah. Hi, Michael. It's Alan.
Yes,
Can you
Alan.
just show clients that have rentals in their corporation?
Sure. So I actually have something because it's a little bit more involved. So I brought up the PDF file that went with the recent newsletter. And I just want to remind you that if you scroll down to the second page, you'll see the notes that relate to private companies. And it was spoken about here. See page 2 for details. So again, the changes to the lifetime capital gains exemption starting at $1,250,000 and then starting in 2026 indexed, and then the whole new set of rules relative to the Canadian Entrepreneurs Incentive. So I have a file in here, and let me just switch to the solution. Where's it? Private company shares. And it doesn't matter if you're using the private company share light feature in VisionWorks or whether you're actually importing the shares from HorpWorks. So in this example, I've got a share that's just worth $1, the original cost. But what I've said is the current value is $3 million. So we've got a $3 million capital gain. I wanted to get it well above the lifetime capital gains exemption. And the important thing to have a look at is when you make a sale entry, so you click the lower table, if you click the upper table, the button, it shows buy. If you click the lower table, the button says sell, so you can then put in the sale. But now that I have that entered, I'm going to click edit. So I want you to notice that you have to select qualifies for the lifetime capital gains exemption or qualifies for the Canadian Entrepreneurs Incentive. This incentive has got an awful lot of restrictions. So if we go down and have a look, it doesn't apply to professional corporations, corporations whose business is financial, insurance, real estate. I mean, even arts, recreation, entertainment doesn't apply. And the shareholder has to be a founding shareholder, having held the shares for 5 years before their sale, and owned at least 10% of the voting shares. So there are a lot of restrictions on this. So you've got to be really heads up about whether or not you select these check boxes. And then it's without them selected, then of course, if I go in and have a look at the capital gain, sorry, this is in 2025, I've done it in order to see the effect of the CEI. Then we can see that the capital gain is $1,958,000, and that's 100 this taxable gain, that's 125,000 on the first $250,000, and then 66 2/3% on the remaining $2,750,000, and we get to the 1958. But then you have the ability to go in, you have the ability to go in and say, it's subject to the lifetime capital gains exemption, or even the CEI. And then when you do that, then you'll see the change in the taxes. So really the key to all of this is just to make sure that you have, you can see the capital gains deduction kicking in, is to make sure that you've included the lifetime capital gains exemption and the CEI check boxes on that sale field. And then you can see taxes payable as compared to, the full load because of the capital gains exemption. Primarily, in the first year, the CEI is only $200,000, and then it escalates $200,000 every year over 10 years. So again, it's one of those things that, the government talks about $2 million, but the $2 million isn't available until 2034. All for your time, and I wish you a great weekend.
Thanks, Michael.
Thanks.
Thank you. Excellent.